The terror begins again.
Assalamualaikum warahmatullahi wabarakatuh. To my beloved lecturer, Madam Nadia Farlina, and my fellow friends. So, my name is Nur Ain binti Abdul Rashid. Today, I'm going to talk about the differences between conventional finance and Islamic finance. So, what is conventional finance? Conventional finance is a home financing scheme that offered by the financial institution or banks which are not guaranteed by the government agencies. Next is what is Islamic finance. Islamic finance is a banking or financing activity that complies with Sharia and its application and its practical application to the development of Islamic economies. Firstly, I'm going to talk about their value proposition. Value proposition is a promise of value to be delivered, communicated, and acknowledgement. It is also a belief from customer on how the value to be delivered, acquired, and experienced. Okay, the first one is it assists in financial inclusion. Okay, for conventional banking system, it is based on paying interest at predetermined rate on deposit of money, and as both payment and receipt of interest are prohibited by the Sharia law, Muslims generally abstain from banking. Through Islamic banking, the financial inclusion can be promoted and large pool of savings can be brought into economy. Next is it promotes the principle of financial justice. Financial justice is the basic requirement for functioning of Islamic finance product. For conventional financing, it looks forward to profit through interest payment and makes the beneficiary completely liable at any risk. But for Islamic financings, it paves way for sharing of net profit loss, and the risk is involved in proportional manner between lender and beneficiary. Therefore, if financier is expecting claim on profit of project, it is necessary he also carry the proportional share of loss of that project. Okay, next is accelerating economic development. Okay, Islamic finance company certainly have profit creation and growth as their objective, for which they will invest in business based on their potential for growth. Thus, in Islamic banking industry, each bank will invest in promising business venture and attempt to outperform its competitors. This is because it want to attract the funds from its depositors. This will result in high return on investment both for bank and depositors. Unlike in conventional banking, where depositors redeem returns on deposits based on predetermined interest rate. Next is operational mechanism. Operational mechanism is control over the pace and direction of initiative. Okay, when people hear about banks, all they can think about is the interest rate that comes with loans. Okay, most people also think that Islamic bank is a financial institution that only for Muslim only. However, it is open to all people. Okay, for operation mechanism in terms of law, Islamic banking basis its operation on Sharia law. It means that the goods that are prohibited in Muslim community will not be traded through this bank. For example, the Islamic banks cannot advance you a loan to open a wine shop. and most of the commercial bank that have Islamic windows will have a Sharia advisory board that comprise of scholars who will provide direction on how the financial institution should operate. Okay, another example for prohibition is maisir. Sharia strictly prohibit any form of speculation or gambling which is called maisir. Thus, Islamic financial institutions cannot involve in any contract where the ownership of the goods depends on uncertain event in the future. Meanwhile, the conventional bank operates on man-made law. Their main motivation is business, and sometimes they take the intervention of government to regulate unethical trading. And these banks have lobby groups that represent their interests when they want to change the law on how they operate. Secondly, concept of money. Money is a medium of exchange, so it can be used to acquire asset or other commodity that are allowed by the Sharia laws. Islamic banks also view money as a store of value, and thus it can be used to value an asset. Okay, Islam considers lending with interest payment is an exploitative practice that favors the lenders at the expenses of borrower. And according to Sharia law, interest is a usury or riba, which is strictly prohibited. In the other hand, conventional banks approach the money in three dimensions, which are commodity, store of value, and medium of exchange. Viewing money as commodity makes it possible that these banks will trade the money at higher price than its face value, and these banks will rent out the money and receive interest when the borrower pays back. Okay, the next operational mechanism is in terms of risk taking. Under the conventional financial institution, the investor do not share the associated risk of the investment. The risk aversion is premised on belief that the borrower must produce return to cover for the principal and interest without any contemplation of risk to his investment. And conventional arrangement is entirely transfer the risk to the client and borrower. However, for Islamic financial institution, it is built essentially of risk-sharing arrangement. Okay, the instruments are built with fairness having in mind, and whoever entitled to returns, he must equally partake in sharing the risk associated with such return. Next, I will share about instrument offer. Financial instrument is a real or virtual document representing a legal agreement involving any kind of monetary value. The example of instrument offered by the Islamic financial institution is mudarabah. Okay, mudarabah is a profit sharing arrangement between two parties who are investor and entrepreneur. The investor will supply the entrepreneur a funds for his business venture and gets the return on funds that he put into the business based on the profit sharing ratio that agreed earlier. Next is musyarakah. Okay, what is musyarakah? Musyarakah is a joint business venture to make a profit. Okay, the profit made will be shared by the partner based on agreed ratio, which may not be in the same proportion as the amount of the investment that have been made by the partner. And however, the losses that incur will be shared based on the ratio of funds invested by the partner. Next is ijarah, which is leasing. Okay, in this type of financing arrangement, the lessor who own the property will lease the property to the lessee in exchange for a stream of rental and purchase payment, ending with the transfer of property ownership to the lessee. Okay, next is the instrument offered by the conventional finance. The first one is investment contract. The financial and investors do not share the associated risk of the investment. In this action, the borrower must produce return for to cover for the principal and interest without contemplation of risk to his investment. And other than that, the bank and customer are not act as a business partner. Next is debt-based contract, for example, housing loan, car loan, and personal loan. And this is the loan which is the interest is charged upon. Next, the differences between Islamic deposits and conventional deposit. Okay, for Islamic saving deposit, the principal amount is fully guaranteed except for mudarabah. But for conventional saving deposit, both principal and interest are guaranteed and predetermined. Next, in Islamic saving deposit, there is no presence of interest. However, upon the discretion of the bank, the depositors may be offered hibah, and which is neither conditional nor promised upfront. But for conventional saving deposit, the interest rate is fixed at the predetermined rate, but is subject to revision. Lastly, for Islamic saving deposit, the deposit is accepted on the condition that the money will be put to work together with management expertise and skills of the bank. However, for the conventional savings deposit, the deposit is a form of debt that given to the bank by the customer. In conclusion, we can see that there are many differences between Islamic finance and conventional finance in terms of value proposition, operational mechanism, and instrument offer. And also, Islamic finance is better than conventional finance. Okay, Islamic finance is based on Sharia law, while the conventional finance based on man-made law. And also, there are many activities that are prohibited by the Sharia law, such as riba, maisir, and others. That's all from me. Thanks for watching.